Welcome, future financial leaders. I'm thrilled to have you here. Today, we are diving deep into the dynamic, high-stakes world of corporate treasury. Let's get started. Let us begin by understanding what a corporate treasurer actually does. You can think of the Treasury Department as the central cardiovascular system of any corporation. While the sales department generates revenue and the manufacturing team builds the products, it is the Treasury team that ensures the money flows to the right place, at the exact right time, and in the correct currency. We exist to bridge a critical timing gap. A company must invest in raw materials, real estate, and labor long before a customer ever pays for the final product. This creates a dangerous void where financial obligations fall due, but cash hasn't arrived. Our fundamental baseline is ensuring liquidity, making sure the business never runs out of cash to operate. We are the guardians of solvency. As we progress through this training, I want you to shift your mindset from traditional accounting, which looks backward at what happened, to treasury, which looks forward to what will happen. We predict cash flows, we protect assets from market volatility, and we propel the business forward by securing the cheapest possible capital. Look at this flowchart, which beautifully illustrates our position in the corporate ecosystem. In the center, we have corporate treasury acting as the grand orchestrator. On the top left, we have customer payments coming in as inflows. However, these inflows are rarely perfectly timed with the outflows on the right: supplier payments, payroll, and operational expenses. When outflows exceed inflows, we pull from the bottom left, external funding, like bank loans or commercial paper, to keep the machine running. Conversely, when we have excess cash, we push those funds to the bottom right for yield generation through short-term investments. Our job is to maintain perfect equilibrium in this flow. If the center runs dry, the entire corporate machine grinds to a devastating halt. Now that we know the overarching goal, let us break down the role into its three core pillars: transactions, balance sheet and liquidity, and risk management. As a treasurer, you wear many hats, but all your activities map back to these three areas. First, we have transactions. This is the operational engine moving money from point A to point B, managing global bank accounts, clearing payments, and ensuring the physical flow of cash is uninterrupted. Second, we have balance sheet and liquidity. This is where we act as strategic advisors. We ask, how are we funding our assets? Are we using short-term debt, long-term bonds, or retained earnings? Our goal here is to optimize working capital and lower the firm's overall cost of capital. Third, we have risk management. The global markets are turbulent. Currency exchange rates fluctuate, interest rates spike, and commodities crash. We must deploy hedging strategies to protect our profit margins from these external shocks. Mastering these three pillars transforms a treasury department from a simple cost center into a strategic partner that adds tangible value to the enterprise. This tree diagram breaks down our structural responsibilities. At the top sits the treasurer, overseeing the entire financial landscape. Branching out, you see our three pillars. On the left, transactions, trickling down into daily bank account management and payment execution. In the middle, liquidity and balance sheet, which drills down into working capital optimization and securing funding. On the right, financial risk management, dealing with the wild cards, foreign exchange, FX, interest rates, and commodities. Notice how distinct these functions are, yet they are all completely interdependent. You cannot effectively hedge risk if you do not understand your transactional cash flows, and you cannot secure optimal funding if your risk profile is out of control. It is a balancing act. Let us dive deeper into the middle pillar, liquidity. The ultimate metric of internal liquidity is the cash conversion cycle, or CCC. As a senior expert, I cannot stress this enough. Optimizing the CCC is like finding free money inside your own company. The CCC measures exactly how many days it takes for a dollar invested in raw materials to come back to us as a dollar of collected revenue. It is made of three components: days sales outstanding, DSO, which is how long customers take to pay us; days inventory outstanding, DIO, how long goods sit in the warehouse; and days payable outstanding, DPO, how long we take to pay our suppliers. The math is simple: DIO plus DSO minus DPO. We want this number to be as small as possible. If we can collect money faster from our clients and negotiate longer payment terms with our vendors, we shrink the cycle. Why does this matter? Because everyday cash is trapped in this cycle. We have to borrow money from a bank to survive, paying heavy interest. By optimizing the CCC, the treasurer reduces external debt, saving the company millions in interest expenses. Let us trace the life of a dollar on this sequence diagram. On day 0, we receive raw materials from our supplier. We negotiate a 30-day term, so on day 30, cash leaves our hands to pay the supplier. This is our DPO. Now, it takes us until day 60 to manufacture and sell the good to our customer. This is our DIO. The customer then takes 30 days to pay us, meaning we finally receive cash on day 90. That is our DSO. From the day we paid cash out on day 30 to the day we received cash in on day 90, there is a 60-day gap. During those 60 days, our cash is trapped. This diagram perfectly illustrates why the treasurer must constantly monitor the operations teams. If we can push the supplier payment to day 45 and force the customer to pay on day 75, we drastically reduce our funding gap. Moving to our third pillar, risk management. Imagine your company sells software to Europe and you expect 10 million euros next month. If the euro crashes against your home currency, your profit margin evaporates instantly. To prevent this, we use a world-class methodology known as the image framework. IMAG. First, identify what exactly is our exposure. Is it a foreign currency, a floating interest rate, or the price of raw copper? Next, measure how much could we lose in a worst-case scenario. We use tools like value at risk, VAR, or scenario analysis here. Third, account. How will this impact our financial reporting and hedge accounting? Fourth, govern, executing the risk strategy. Do we use a forward contract to lock in a guaranteed price, or buy an option contract to protect the downside while keeping the upside? Finally, evaluate. We constantly monitor the performance of our hedges against our baseline targets. Risk management isn't about gambling, it is about creating certainty in an uncertain world so our business leaders can plan confidently. Take a look at this cyclical flow, the image framework. It starts on the left with identify, moving linearly through measure, account, and govern. Notice that this is not a straight line that simply ends. The final node, evaluate, sends a dotted feedback loop right back to the beginning. The markets are incredibly dynamic. A currency that was stable yesterday might become highly volatile tomorrow due to geopolitical events. Therefore, our evaluation phase must constantly feed fresh data back into our identification phase. This continuous, unbreakable loop is the hallmark of a mature, sophisticated corporate treasury operation that never gets caught off guard. Now, let us discuss how a modern treasury is structured. You cannot just put a group of smart people in a room and tell them to move millions of dollars. You must have airtight governance. We enforce a strict segregation of duties by dividing the department into the front, middle, and back office. The front office consists of the dealers and transactors. They decide where to invest cash and negotiate foreign exchange hedges with the banks. However, they are absolutely forbidden from moving the actual money. That is the job of the back office. The back office receives the trade tickets, independently confirms the details with the bank, processes the settlement, and pushes the accounting entries to the general ledger. Sitting between them is the middle office. The middle office is the ultimate control tower. They validate pricing models, ensure the front office hasn't breached their trading limits, and report risk metrics directly to the CFO. This triad ensures that a rogue employee cannot initiate, approve, and settle a fraudulent transaction. It is the bedrock of corporate financial security. This organizational chart clearly maps our chain of command and information flow. The CFO sits at the top, overseeing all three divisions. You can see the front office, middle office, and back office side by side. The solid lines represent reporting hierarchy. But pay close attention to the dotted lines. The front office sends trade details to the back office, but they do not control them. The middle office casts a watchful eye over both auditing the front office's trading limits and reconciling the back office's settlement data. This triangulated tension is deliberately designed to catch human errors instantly and make internal fraud virtually impossible. What does an actual day look like for a corporate treasurer? The day begins early and is highly structured. The first critical task, usually completed by 9:00 a.m., is determining the daily cash position. We download bank statements globally, reconcile yesterday's expected flows against actuals, and figure out exactly how much cash we have. Are we short in Europe? Do we have a massive surplus in Asia? By late morning, we must execute. If we are short, we issue commercial paper or draw down on bank credit lines. If we are long, we invest the surplus in money market funds. We also clear all mandatory daily payments. After lunch, the focus shifts from operations to strategy. The afternoon is dedicated to risk management, reviewing FX exposures, executing hedges with our banking partners, and dealing with exceptions or trapped cash in restricted countries. The day concludes with rigorous reporting, updating the CFO on our liquidity status and market views. It is a thrilling, fast-paced environment where you start the day looking at detailed bank feeds and end it making multi-million-dollar strategic decisions. Follow this linear timeline to see the rhythm of our day. We start on the left with morning tasks, cash positioning, and reconciliation. This is all about gathering data. As we move right into midday, we enter the action phase, executing funding and clearing payments before bank cutoff times. As the operational pressure eases, we move to the afternoon, hedging and strategy, where we engage the markets. Finally, on the far right, we hit the evening phase, reporting and end-of-day EOD close, sealing the books tight so we can sleep soundly and start fresh the next morning. It is a disciplined, predictable loop in an unpredictable market. In the modern era, a treasurer is only as good as their technology. The days of managing billion-dollar cash flows on fragile, manual Excel spreadsheets are over. Today, we rely on a centralized treasury management system, or TMS. The TMS is the brain of the operation. It interfaces directly with our internal enterprise resource planning system like SAP or Oracle to understand what invoices are due. Simultaneously, it connects to our global banking network via SWIFT or Direct Application Programming Interfaces, known as APIs. This allows us to achieve straight-through processing. This means a payment can be generated in the ERP, routed through the TMS for automated compliance checks, and sent to the bank for clearing without a single human ever touching a keyboard. Below, I've provided a sample JSON payload. This is exactly what the code looks like when our TMS pings a bank API to instantly retrieve our current cash balance. Mastering this technology layer allows the treasurer to focus on high-level strategy rather than data entry. Look at this system's architecture diagram. At the top, we have the company ERP system, which holds all our payables and receivables data. It feeds this directly into the central hub, our TMS. The TMS then reaches down via secure APIs or the SWIFT network to communicate with our global banking network. The bottom arrow shows the magic of modern APIs. The bank servers immediately return a JSON payload, literally a tiny piece of code saying balance 1.5 million USD straight into our system in milliseconds. This seamless interconnected web is what allows a tiny team of 5 people to manage the cash for a massive multinational corporation. Let us bring it all together with a real-world use case. Imagine a sudden, global macroeconomic shock like the 2008 financial crisis or the recent global pandemic. Credit markets freeze entirely. Suddenly, your customers panic and stop paying their invoices, skyrocketing your day's sales outstanding. Meanwhile, your anxious suppliers are demanding immediate payment. This is a severe liquidity squeeze. If you rely on decentralized, local operations, you will go bankrupt. But a world-class treasurer springs into action. Using the TMS, we instantly gain global visibility of all cash. We utilize cash pooling to physically sweep surplus funds from our Asian subsidiaries to cover deficits in Europe. We aggressively draw down our pre-committed bank credit lines before the banks can restrict them. We hold all non-essential FX hedging and focus purely on cash preservation. This is where Treasury leadership shines, turning a defensive nightmare into corporate survival. I hope this masterclass has ignited your passion for corporate finance. If you found this valuable, I invite you to like, subscribe, and visit quicktechie.com for premium certification prep, including Q&A banks, full ebooks, audiobooks, full-length training, and interview guides. Your journey to financial mastery starts there. This final flowchart maps the anatomy of a crisis response. At the top, the global market shock triggers the next phase, credit markets freeze. The typical company panics here. But following the arrows downward, the prepared treasurer takes 2 immediate actions, drawing down credit lines to secure cash and implementing global cash pooling to mobilize trapped internal funds. Both of these strategic actions converge at the bottom node, enterprise survival and stability. This is the ultimate testament to a treasurer's value. Thank you for joining me, and remember to check out quicktechie.com to continue your professional growth.